A bank is a quiet building until the day it stops being quiet. On a normal morning, it is marble floors, polished counters, and the soft confidence of routine. People deposit wages, shop owners make change, clerks stamp papers with practiced hands. It feels permanent. Then, one rumor moves through a town like wind through dry grass. They might not have your money. And suddenly, the bank becomes something else, a threshold, a test, a place where trust either holds or snaps. This is the Great Depression story most people don't fully picture. Not just falling stock prices, not just breadlines, not just headlines from New York. The real collapse happened in thousands of ordinary places, in moments when neighbors decided to stop believing in the same system at the same time. Because a bank does not keep everyone's money in a vault, it can't. It takes deposits and turns them into loans, mortgages, business credit, farm loans, bets on tomorrow. The system works only if people don't demand tomorrow all at once. That is what a bank run is, a crowd demanding now. And once now becomes the priority, the machine breaks. In the 1920s, America looked like a nation that had mastered prosperity. Factory output surged, radios entered homes, cars turned distances into minutes. Credit expanded. People bought appliances and houses with monthly payments, trusting that wages and growth would continue. Meanwhile, the financial system grew more complex and more fragile. Many banks were small, local institutions tied to regional fortunes, farm prices, a mill's payroll, a single town's business cycle. They held little cushion for panic. They depended on calm. And calm depends on confidence, not accounting. Then came 1929. The stock market crash is often told as the opening gun, but the crash alone did not create the depression. It was the first crack in a wider structure of leverage and expectation. When asset prices fell, wealth shrank, spending slowed. Spending. Businesses cut back, workers lost jobs, loans went bad. Banks, already exposed, began to wobble. Here is the cruel part. When people sense wobble, they create it. Imagine a shop owner in a small Midwestern town in 1930. He opens his ledger and sees fewer sales. He hears a neighboring bank is tightening. He knows his suppliers want payment. He decides to withdraw a little extra cash, just in case. His neighbor sees him leaving the bank with a thicker envelope. The neighbor thinks he knows something. The neighbor withdraws too, then another, then another. Within a day, a line forms. And inside the bank, clerks begin doing the math that no one wants to admit out loud. They can pay out to the first wave. They can even pay out to the second wave. But if the whole town shows up, the bank will have to sell assets fast, loans, bonds at terrible prices. And in a crisis, buyers demand discounts. The bank becomes insolvent not because it was evil, but because it is being forced to liquidate tomorrow at today's panic price. A bank run is a self-fulfilling prophecy in polished shoes. People often imagine depositors as irrational in these moments. They aren't. They are responding to incentives. If you arrive early, you might get your money. If you arrive late, you might get nothing. That logic turned civilized citizens into a queue. The early 1930s saw wave after wave of bank stress. Failures were uneven at first, one region, then another. But fear travels. And when one bank fails, it plants a dangerous idea. The next one can fail too. Some banks tried to stay open by limiting withdrawals. Others begged local leaders for calm. In some towns, the bank president stood at the door and promised stability with a voice that sounded steadier than he felt. But confidence is not restored by promises alone. Confidence is restored by proof. As banks failed, money itself began to change its behavior. People hoarded cash, businesses held back on investment. Consumers delayed purchases. This seems sensible individually, but collectively it strangles the economy. Spending falls, businesses earn less, layoffs rise, loan defaults rise, banks weaken, spending falls again. That is the depression's engine, a tightening loop of fear and contraction. Now add deflation, prices falling. Deflation sounds pleasant in casual conversation. Who wouldn't want cheaper goods? But falling prices can be lethal in a debt-based economy. If wages drop and prices drop, the real burden of debt rises. A farmer still owes the same number of dollars, but his crops sell for less. A homeowner still owes the same mortgage payment, but his income shrinks. Defaults increase. Banks take losses, credit dries up further. And then there's gold. America was effectively tied to gold in this era, which limited how aggressively the Federal Reserve could expand money and credit. In a crisis of confidence, gold drains mattered. Policymakers feared that creating too much money would threaten the gold position. Restraint was treated as responsibility, even when responsibility was feeding collapse. For ordinary Americans, the gold constraint was invisible. What they saw were closed banks with handwritten notices. What they felt was the humiliation of being told their savings were trapped. If a bank closed, depositors might receive scrip or promises, or they might wait for liquidation proceedings. For families living paycheck to paycheck, waiting was not an option. A single bank failure could turn stability into desperation. This is why breadlines appeared, not because people suddenly forgot how to work, but because the financial arteries stopped carrying oxygen. By 1932, the situation was so severe that the political system began to fracture too. Anger rose. The public demanded action, not speeches, action. When Franklin D. Roosevelt took office in 1933, the banking system was in crisis. Runs were widespread. States had begun declaring bank holidays to stop withdrawals. The country was approaching the point where payments themselves might cease. Roosevelt's response was blunt: a national bank holiday. Banks would close temporarily. They would be examined. Only those judged solvent would reopen. This was more than a technical measure. It was theater with teeth. It signaled that the government would separate sound banks from unsound ones and would stand behind the reopened system. Then came the moment that mattered most: communication. Roosevelt spoke to the public in plain language, explaining what banks do and why panic destroys them. He treated citizens like adults, not like a crowd to be managed. He asked for patience and offered a clear plan. In a crisis of trust, clarity is a policy tool. Banks reopened. In many places, lines formed again. But this time, something different happened. Depositors redeposited cash. People who had hoarded bills under mattresses brought them back. The system breathed again. Not because fear vanished, but because the government had introduced a new source of confidence: explicit backing and visible inspection. The deeper reforms followed: stronger federal oversight, the creation of deposit insurance to reduce the incentive for bank runs, and steps to stabilize finance. This is the lasting lesson of 1929-1933. Modern economies are not only made of factories and farms, they are made of trust networks. When those networks break, real production collapses even if the physical tools still exist. The Great Depression is often remembered as an era of poverty. But its first act was psychological. The day people decided the rules no longer protected them. A bank run is the purest form of financial panic, because it turns belief into action. It takes an invisible fear and makes it visible in a line that wraps around the building. And once you've seen that line, you don't forget what it means. Because you realize the frightening truth: your money is not just in the bank, it is in your neighbor's faith.